So welcome back to the next lecture of financial institutions. So in the last lecture we discussed about the basics of banking sector. We discussed the RBI, the functions of RBI we discussed, and then we discussed the structure of the banking system of India. What is scheduled bank, non-scheduled, commercial, non-commercial. All these things we discussed in the last lecture. Then we discussed the non-banking financial company. What is the role, what is the positive, negative about non-banking financial company. Then we discussed two most important topics, payment banks and small banks. So after this basic thing, the next we have is the banking sector reforms, the different reforms which came in the banking sector. So first reform, when we got liberalized, the economy got liberalized in 1991, the banking sector started getting reformed. So the first committee which is related to the banking sector reforms is the Narasimham Committee. So in 1991, Narasimham Committee was set up, and Narasimham was the ex-governor of RBI. He was very well aware about the problems of the RBI and he gave the recommendations. So the first recommendation of now, because this year MCLR came from 1st of April 2016, MCLR became effective. So that is why this banking sector reforms committee, it becomes relevant from the perspective of pre as well as mains, subjective exam as well as objective exams. So the first recommendation of Narasimham Committee is decrease CRR and SLR. In 1991, the present value of CRR and SLR. In 2016, its value is CRR is 4% and SLR is 21.5%. The value of CRR and SLR in 1991, it was 15%. It was 39%, more than 38%. So this was the value of CRR and SLR. Think about this situation in which suppose A deposited 100 rupees. Out of this 100 rupees, 39 rupees you have to keep in the form of SLR, 15 rupees you have to keep in the form of CRR. So this is the only money which is left, which this bank was able to lend to the general public. So no credit creation capacity of the bank. So Narasimham Committee recommended decrease the value of CRR and the value of SLR. And whether the recommendations were accepted or not, so yes, of course, the recommendations were accepted in a phased manner. Then the next recommendation was decrease the value of PSL, priority sector lending. So at that time it was 40%. Narasimham Committee said decrease it to 10%. So whether the recommendation was accepted, of course not accepted, because right now also we have 40%. So compare this Narasimham Committee recommendations with Nachiket More recommendation that we discussed. That Nachiket More said increase it from 40% to 50%. And that hardship areas we discussed, and rather than measuring that March rush, because of March rush, measure the targets of PSL on the quarterly basis and not on the annual basis. Then deregulate the interest rate. So Narasimham Committee, before Narasimham Committee, both the rates, the rate at which you were borrowing, it means you have to pay some amount. So this rate was decided by RBI, and the rate at which these banks were lending. So both these rates, they were decided by RBI. Then it was liberalized and benchmark prime lending rate came. So what was the benchmark prime lending rate? It was related to this time. When the bank was lending, at that time, there was a benchmark prime lending rate. So what was the benchmark prime lending rate? It was the rate at which the bank was giving a loan to the most credit-worthy borrower. Now this most credit-worthy borrower, it is a subjective concept. And suppose RBI was fixing the value. How RBI was fixing the value? Whatever BPLR is decided by a bank. For example, the bank said my most credit-worthy borrower is this, and I am lending at 8% interest rate. So what RBI was saying, that your BPLR is 8%, to small scale industries you will lend at BPLR plus 5%. Maybe to agriculture you will lend at BPLR plus 4%. So RBI was fixing the value indirectly, and bank themselves, they were deciding the value of BPLR. But the problem is this definition was subjective. There was no transparency how these banks, they were deciding the value of BPLR on the basis of most credit worthy borrower. Because sometimes the bank, what they were saying that suppose there are three entities which have taken the loan from bank. First one is Infosys, then second one is Microsoft, and third one is Government of India. So when Infosys took a loan, the bank said Infosys is my most credit worthy borrower. When Microsoft took a loan, the bank said Microsoft is my most credit worthy borrower. And to Government of India, so they said Government of India is my most credit worthy borrower. So this credit worthiness, it is a subjective term. When your customers will change, this value is going to change. So when you have already lended as on the basis of Infosys, now you cannot change on the basis of Government of India. So this most credit worthy borrower is a subjective concept. Rather than having this most credit worthy borrower, give a minimum value that to whoever you are going to lend, you cannot lend below 8%. You will lend above 8% only, whoever will be the borrower. So this new concept, it came in 2010, that is known as base rate. So Abhijit Sen committee was set up to revive or how to make this BPLR transparent. Abhijit Sen committee in 2010 said BPLR should be abolished and it should be replaced by base rate. And what is base rate? Base rate is the rate below which bank cannot lend to anybody for commercial purpose. Be it anybody, credit worthiness, irrespective of the credit worthiness, bank cannot lend to anybody below this, whatever is the value that is being decided by the bank. So this new concept is known as base rate. Suppose this is bank, SBI is there, and SBI is deciding the base rate. SBI is having two customers, one is agriculture sector and second is Infosys, and RBI is fixing a cap that to agriculture you have to lend at base rate plus 5%. So this cap is being fixed by the RBI. So now as per this cap, when SBI is deciding the base rate with respect to these customers, then SBI wants to keep the value of base rate more, so that this value will be more, so that the rate at which SBI will lend to agriculture will be more. So on this side, SBI wants to increase the value of base rate, because when base rate will be more, this value will be more, and when this value will be more, the rate at which SBI is lending to agriculture will be more, because agriculture is a risky lending. So RBI wants to lend at high interest rate. So this is scenario. On the second hand, when Infosys wants to borrow, so there is no cap by RBI, but Infosys is more credit worthy, and Infosys is having option. If the base rate of SBI is more, then Infosys maybe borrow from ICICI. So SBI has to take care of the Infosys also. So you have two types of customers of SBI. For agriculture loan, SBI wants to increase the base rate. For Infosys, SBI wants to decrease the base rate. So SBI will take care of both these things, both type of customers, while deciding the value of base rate. This is one thing. The second component which decides the value of base rate is the cost of borrowing, the rate at which SBI itself borrows. Suppose due to inflation, the rate of interest becomes 8%. So SBI cannot lend at 8%. SBI will keep some commission, or maybe SBI will fix the base rate as 12% or 13%. So these two things SBI considers, the type of customers of the bank plus the cost of the borrowing. But there was still problem in case of base rate. The problem was like, suppose SBI is borrowing from RBI at repo rate, and SBI is having some other customers also, A, B, C. We discussed why the monetary policy of India is not that effective. So when RBI is decreasing the repo rate, it means the policy is for expansionary monetary policy. Because RBI is decreasing repo rate, RBI knows that there are some liquidity crunches in the economy, so RBI wants to increase the liquidity in the economy. But finally, the liquidity in the economy will be increased or decreased by the actions of these banks, because RBI does not directly involve in the retail lending. So unless and until SBI decreases the interest rate, the money supply in the economy will not increase. So ultimately the decision has to be taken by the SBI. But there was no fixed time frame. Even if RBI is decreasing repo rate after every 2 months, every 3 months, but there was no one-to-one relationship, because changing of base rate by the bank was not fixed. That time frame, that frequency was not fixed. It was the total discretion of the bank. Whenever they want to change the base rate, they can change it, because base rate was decided by the SBI. And even though RBI decreased repo rate, again it is the discretion of the SBI to decrease the base rate or not. And base rate was the rate which was deciding the rate at which loan will be given to these different sectors. So there was no one-to-one relationship, and this is known as monetary transmission. Monetary transmission means whenever they were lending, whatever the policy, whatever the objectives of the monetary policy, whether they are able to replicate, reflected in the economy or not. If they are able to reflect in the economy, so we have good monetary transmission. If they are not getting reflected, it means we have bad monetary transmission. So these are the major problems of base rate. In detail we will discuss in MCLR, the very next topic. So deregulate base rate. So these rates has been deregulated. Now the rate at which the banks were borrowing, that also has been deregulated. Whether SBI wants to keep it as 4% or Kotak Mahindra Yes Bank, they want to keep it as 6%. It is totally their discretion. Whatever they want to keep, they can keep it. As well as the rate at which they are lending, it was base rate, and base rate was decided by the bank themselves. So this next deregulate interest rate, this recommendation was accepted. Then we have the asset reconstruction fund. So asset reconstruction, and we have asset reconstruction companies also. The asset reconstruction concept says, suppose this is SBI, and SBI has given a loan to A. Against this loan, A has given some mortgage. So for 90 days, not a problem. If A is not repaying the EMI, if A is not paying EMI or interest for 90 days. So for 90 days it's not a problem, but after 90 days this will become the NPA, and when it becomes NPA, the bank will attach your property, and now after 90 days bank want to sell these paper of house in the market. But to sell these paper in the market, SBI has to involve, SBI has to engage the manpower in advertisement. Then the authenticity of the buyer, what will be the price at which the buyer will purchase, the negotiation will take place. But that is not the work of SBI. SBI is a bank. The work of a bank is for intermediation. So rather than itself engaging in all this thing, SBI thought, why don't I outsource this work of selling my bad assets in the market to an external body, and this external bodies, they are known as asset reconstruction companies. So the role of the asset reconstruction companies is they purchases the bad debts. This is what the bad debt is. They purchases the bad debts of the banks, and in return they pay at some discounted price. It means suppose SBI gave a loan of 10 lakh rupees. In return A gave house paper of 12 lakh rupees. So now SBI wants to purchase it. So ARC will not pay full 12 lakh or 10 lakh. ARC will keep some commission. So that after keeping some commission, then whatever the remaining funds, this asset reconstruction company will repay to SBI. So this Narasimham Committee said government should set up its asset reconstruction company, At present, we have only private sector, only private companies, private ARCs we have. Even this economic survey said that government should establish the asset reconstruction company. Then we have the capital adequacy ratio should be increased. So the capital adequacy ratio we discussed, CAR equals to paid up capital upon risk weighted assets. This we discuss under SLR. But this is the simplest definition. Actual में capital adequacy ratio equals to tier 1 capital plus tier 2 capital upon risk weighted asset, and paid up capital is just one component of tier 1 capital, and we will discuss this all this thing in detail in the next lecture, where we are going to discuss the Basel norms, the need of the Basel norms, first Basel norm, second Basel norm and third Basel norm. Basel norm is relevant from exam perspective. Then this capital adequacy ratio, so the Narasimham Committee said its value should be more. So at present, as per the RBI guidelines, its present value as per this Basel 2, it is 9%. As per Basel 3, it will be 12%. So this is what the RBI has subscribed. It's not what mentioned in the Basel. Just like in case of Basel 3, it is mentioned 10.5. In that norm, it is mentioned 10.5. But RBI said to banks that you have to implement 12%. Then the Basel norms should be implemented in India. The first Basel norm was accepted, implemented in 1999 during that fourth war between India and Pakistan. The number of wars that we fought with Pakistan is 4. First one was 1947, then second one was 1960s, then third one was 1971, and fourth one was 1999, the Kargil war. So the first Basel norm accepted in 1999. The second one was in India accepted in 2009, and the third one, the deadline is 2019. So after every 10 years. Then MCLR concept. What exactly is MCLR? So first we will discuss what is the base rate. So base rate is the rate below which you cannot lend to anybody for commercial purpose. But there is only one exception. Be it any borrower, whether it is Government of India, Infosys, individual, you cannot lend to anybody for commercial purpose below this base rate. So now RBI is having a fixed value of base rate, and they will add maybe 4% or 5% to base rate, and they can say you have to give a loan to small scale industries on the basis of this base rate only. So there is only one exception of base rate, and that exception is in case of agriculture, we have interest subvention scheme. The interest subvention scheme we already discussed. Interest subvention scheme is you have to lend to agriculture sector at 7%. So 7% is below this base rate. So this is the only exception. Actually, what is interest subvention scheme is if the farmer repays the loan on time. If suppose this farmer got a loan in 2016 and by the deadline is 2017. So if in 2017 you will repay, you will get an exemption of 3%. So effectively this farmer in 2007 has to pay 4% only. But if this farmer wants to pay in 2018, then this farmer has to pay full 7%. So this is the interest subvention scheme. So this interest subvention, this is being borne by Government of India. So this is the subsidy of Government of India. But this 7% which is much below the market rate, this is being borne by the respective bank. Whatever that bank, it is your problem, but you have to lend to agriculture at 7% interest rate only. Then this is what base rate. Then what is the need of MCLR? The need of MCLR, first we discuss the time frame. The updation of base rate was not fixed. MCLR is marginal cost of funds based lending rate. This is the full form of MCLR, where this word marginal means changed situation. Changed situation means if the rate at which you are borrowing has changed, so you should also change the rate at which the bank is lending. So the rate at which you are borrowing, one of the client is RBI. Through repo rate you borrow. So if RBI is increasing or decreasing the repo rate, the same should be replicated here. But earlier it was not being replicated because there was no one-to-one relationship between repo rate and MCLR. Because the banks were not considering the value of base rate while the banks were not considering the value of repo rate while deciding the base rate. But now the formula has changed. These are the four components of MCLR. So first will be this MCLR will be changed after every month. There will be a revision of this thing after every month. And it's not like for all the customers there will be only one base rate. There will be only one MCLR, like base rate was fixed. Here we have a tenure system, in the sense if somebody is taking loan for 2 months, then different MCLR will be there. If somebody is taking for 1 year, then the value of MCLR will be different. So in total there were 5 tenures that will be decided by the banks, that for this much of tenure my MCLR is this, for this tenure my MCLR is this. So these are the new features. Tenure is fixed. As per the tenure, value of MCLR will be fixed. The monthly revision component, that is again new. Then the one-to-one relationship between repo rate and MCLR is new. So these are the 4 components. Depending on the basis of these 4 components, the bank will decide their MCLR. So the first one is negative carry of CRR. The negative carry of CRR, we discussed in CRR that no interest after 2006, RBI is not paying any interest. To the banks for the value of CRR. So it is a kind of tax only. So banks, they have to offset the loss of interest on the CRR. So how they will offset? They will offset it by increasing the rate here. So the amount of money which the bank is giving in CRR, in which the bank, they are not getting any interest. So what the banks will offset this loss from this loss. So they will slightly increase the interest rate at which they are lending while deciding the value of MCLR. So this is what the negative carry of CRR. Then the next one is the operating cost. Of course, the bank must be having some operating cost. Employees are there, business is there, desk is there, buildings is there and all. So whatever is the operating cost also will be considered while deciding the value of MCLR. And next one is the tenor system. The tenor says if you are lending for short duration, then the rate of interest will be less. But if you are lending for long duration, then your rate of interest will be more. This happens always. In case of normal savings account, the rate of interest is 4%. In case of FD, if the maturity period of FD is more, the rate of interest will be more, because you are committing, your commitment is of for the longer durations. You want more interest rate. So that tenure will be considered. And next is the latest one, marginal cost of funds. So this marginal cost of funds, it includes components like, it includes the interest rate, different interest rate of savings account, current account and FD, which the bank is offering. So this interest rate they have to consider. The second thing that they have to consider is the value of repo rate. So this is the new thing. So now there is a one-to-one relationship between repo rate and the MCLR. When RBI will increase repo rate, so the value of MCLR will be increased. If the value of repo rate decreases, then banks will also decrease their MCLR. So this is what the new thing is, marginal cost of funds. Now it directly considers the value of repo rate. So This is a new concept, MCLR, marginal cost of fund based lending rate. It has already started in India from 1st of April 2016. But this is highly relevant from exam perspective. Then we have the J Nayak Committee. So last year, RBI has set up J Nayak Committee. That was for the governance of public sector banks. So public sector banks, they are being set up or nationalized. So at present, who owns these public sector banks? It is the government of India. So there is a very good line that it is an irony that the government disadvantages the only bank which they have set up. So they themselves set up these banks, but because of n number of problems, these problems are highly fragile. The condition is highly fragile. Then the political intervention. Then there is dual regulation. Dual regulation means they are being regulated by Ministry of Finance for developmental purpose and they are being regulated by RBI for all other functions. So dual regulation of public sector banks is there. Then recently a 50 crore scam was being caught from Syndicate Bank, I think. So because of all these things, you have to reform the board, the method of selection of the chairman, the CEO and all these things. So this board level should be reformed. And how to reform is that was recommended by J Nayak Committee. So first they said there is a problem of dual regulation, both regulating. The second problem is the external vigilance, because it is a government thing. So there is an external vigilance of CBI. CBI can come up, but CBI cannot go to ICICI because ICICI is a private entity. So unless and until a case has already been framed, till that time CBI cannot go. Then there is an external vigilance of CVC also. Every time they have to send the report to CVC. Then RTI, a single application. Any person can get majority of the information of public sector banks using this RTI. Even ICICI can take some information from using RTI. So this external vigilance is a major problem. Then the method of appointment. There is no transparency in the method of appointment. Who appoints, when appoints. Again, there is a lot of political intervention is there. So J Nayak suggested that all this problem is there because we have a fragmented banking system. They said make a new company that will be known as Bank Investment Company. And whatever the shares of Government of India in all these different banks, whatever that different public sector banks that we have, whatever share of Government of India. For example, in SBI there is 58% share of Government of India. In this, for example, 69% is there. These are the rough figures I am telling you. So transfer this to this Bank Investment Company. And BIC will be under Government of India. So create a new company naming Bank Investment Company under Companies Act 2013. Don't create it by some statutory body, because otherwise you will have to take the permission of the parliament even if you want to make some changes in BIC. So make it a separate company so that you don't have to take permission of the parliament, and government should own this full BIC, Bank Investment Company, and whatever the existing acts like SBI Act, Nationalization Act are there, they should be repealed, and it should be this existing bank, they should become the subsidiary of BIC. This will be the big company, and this SBI, PNB, all these different nationalized banks, they will become the subsidiary of Bank Investment Company. Then how it will be beneficial? It will be beneficial that right now the appointment of SBI, risk, appointment of PNB, risk, appointment of BOB, risk, appointment of Dena Bank, risk in the sense political intervention is there, biasness can be there, no transparency is there. So they said the chairman or the CEO of BIC, it should be appointed through a search panel. And when they are saying search panel, it means from both private as well as public. So the CEO should not only be a bureaucrat. CEO can be from the efficient banker, it can be from the private sector. So the CEO of BIC, it should be appointed through a search panel. Right now there is no search panel. SBI chairman, the bureaucrats decide who will be the next chairman. Anyways, in this case, CEO will be appointed through the search panel, and this bank investment company, which is owned by Government of India, now this CEO under this bank investment company, they will recruit the CEO and chairman of SBI, PNB, Bank of Baroda, Dena Bank. So that regular intervention, that regular political intervention, that can be stopped from the individual banks. So this is what the purpose of the bank setting up of the bank investment company, that the political intervention at this level, at the appointment of the board of these different banks, that can be stopped. Because once BIC will be there, so BIC will decide who will be the board member of these banks. Then they also recommended Bank Board Bureau. This Bank Board Bureau will be a temporary concept. Till the time BIC will be established, till the time these acts will be repealed, just create a Bank Board Bureau, and that will be decide the board of this SBI, PNB, BOB and all this thing. So the purpose of PJ Nayak was stop this regular political intervention at each and everything. Just create a separate body. So BBB will be a temporary concept till BIC will be established. Once BIC is established, then BIC board will decide the board member of this different nationalized bank. Then the second recommendation is no developmental regulations from Ministry of Finance. They said stop sending any developmental regulations, because on the one hand ICICI is not getting any developmental regulation, SBI is getting a developmental regulation. So how SBI will perform? How can you improve the efficiency of SBI? So the option is stop sending any developmental regulations from Ministry of Finance. The next one is the fixed tenure of chairman. The tenure of the chairman should be fixed. It should not be like after every 4 years, after every 3 years, or as per the discretion of the bureaucrats. It should not be changed. So they said the tenure of chairman should be 5 years and it should be fixed. Then the next recommendation was no Indian bank is there in top 50 in the world. Although we have SBI, the India's largest bank, but not even SBI is there in the top 50 rank of the world. The reason is Indian banking sector is highly regulated. They are only involved in banking. Banks don't sell insurance, very less. Banks don't sell provident fund. Banks don't sell mutual fund. So they are only being constrained in this thing. The RBI regulation does not allow them to diversify. At present, if these are two banks, this is bank A, this is bank B. Bank A cannot buy more than 10% shares of bank B. A can at max buy. Not even A, anybody can at max buy 10% of the shares of the banks. So if this will be the scenario, the amalgamation of bank will not take place and no big bank will take place. As well as the diversification of the business is also highly regulated. If they want to sell to insurance, again they have to take some permission. Provident fund, mutual fund, SIP, all these things, it requires a lot of regulation. So PJ Nayak suggested that create a new entity that is known as authorized bank investor, and who can be designated as ABI. This ABI can be a mutual fund, this ABI can be a provident fund, but this ABI cannot be any insurance fund and this cannot be any NBFCs. So these two things are not allowed, because if it is a special type of investor to whom you are allowing to invest up to 20%. So this company should not have any direct say in the functioning of these banks. Insurance, they provide insurance to the banks. So you are providing insurance to B also, and you are purchasing 20% shares of B also. So that will become a conflict problem. Similarly, NBFC, they are not the bank, they don't have the license to start a bank, to establish a bank. But here if you will allow to purchase 20% of the shares, so only these two are not allowed to be designated as authorized bank investor. Except these two entities, J Nayak said start a new entity that will be known as authorized bank investor and allow ABI to purchase up to 20% without taking any regulatory permissions. Then the evergreening of the loan. So evergreening of the loan means, in last few lectures we discussed, suppose A is there, SBI has given a loan to A of 100 rupees. Now A has to return this 100 rupees, some principal or interest within 90 days. Otherwise it will be designated as NPA. So if SBI don't want to designate this loan as NPA because there is a lot of pressure, you have to decrease your NPA, you have to decrease your NPA. So the second option is SBI can give a second loan maybe of 20 rupees so that A can repay some amount of the previous loan. This is first loan, this is second loan. So giving a new loan to repay the old loan is known as evergreening of loan. So J Nayak said if the instances of evergreening of loan is deducted in any bank, it should be highly penalized. Just set up an example that no bank will involve in the evergreening of the loans. So these are the major banking sector reforms. In the next lecture, we will discuss about the Basel norms, the need of Basel norms, Basel 1, Basel 2 and Basel 3 norms. Thanks a lot.